bank stocks are falling, and for many investors, the reason seems obvious. Headlines point to regulation, political pressure, and slowing growth. Prices drop, narratives form, and fear fills the gaps. But markets rarely move for just one reason. And when bank stocks fall together, investors often miss the deeper signal. Today's decline is not about a single policy proposal or a single earnings report. It is about how investors are reassessing risk across the entire financial system. Banks sit at the center of the economy. When confidence in banks shifts, it reflects broader concerns about credit, growth, and stability. The first thing investors notice is regulation. Talk of interest rate caps, tighter lending rules, or political intervention immediately raises concerns about profitability. Banks make money from spreads. They borrow at one rate and lend at another. Anything that compresses that spread threatens earnings. But focusing only on regulation misses the larger picture. Markets are not just reacting to what rules might change. They are reacting to uncertainty about how predictable the environment will be. Banks thrive on predictability. Stable policy allows them to price risk, manage balance sheets, and plan capital allocation. When predictability declines, valuation multiples shrink even before profits do. This is why bank stocks often fall before earnings weaken. Another factor is credit quality. Banks are leveraged institutions. Small changes in loan performance can have outsized effects. When economic visibility declines, investors worry about defaults long before they appear in financial statements. Rising interest rates have already increased pressure on borrowers. Households, businesses, and governments are all adjusting to higher costs of capital. Banks are exposed to all of them. Even if loan books remain healthy today, markets price what could happen tomorrow. This forward-looking behavior often looks like overreaction, but it is how risk is managed. There is also the issue of funding costs. As rates rise, banks must pay more to attract deposits. Competition for deposits compresses margins. At the same time, regulators demand higher capital buffers, limiting how aggressively banks can deploy capital. Lower leverage, higher costs, and uncertain growth are not a friendly mix for valuations. Investors sense this before it shows up in quarterly numbers. Another overlooked factor is political risk. Banks are easy targets during periods of economic stress. They are visible, profitable, and unpopular. Policy discussions often frame banks as tools for broader economic goals, not as businesses. Markets understand that political pressure can distort incentives. Even the possibility of intervention forces investors to demand a higher risk premium. This is not about ideology. It is about uncertainty. When rules feel flexible, capital becomes cautious. There is also a global dimension. Modern banks operate across borders. Currency risk, regulatory divergence, and geopolitical tensions all matter. When uncertainty rises globally, bank stocks suffer disproportionately because they are exposed everywhere at once. Technology adds another layer. Fintech, competition, payment disruption, and alternative lending models pressure traditional banks' long-term pricing power. These threats do not cause sudden collapses, but they weigh on long-term expectations. Valuations reflect that slow erosion. Many investors focus on dividend yields when bank stocks fall. High yields can look attractive, but yields rise when prices fall, not always because fundamentals improve. A high yield can signal risk, not opportunity. This is where long-term investors separate signal from noise. Warren Buffett has long emphasized understanding the business behind the stock. He favors banks when they are well capitalized, conservatively run, and operating in stable regulatory environments. When those conditions weaken, even strong banks deserve lower valuations. What many investors miss is that falling bank stocks do not automatically signal a crisis. They often signal repricing. Markets adjust expectations gradually, not suddenly. A decline can reflect lower future returns, not imminent failure. This distinction matters. During past cycles, bank stocks have underperformed long before recessions became obvious. They act as early indicators, not confirmations. That is why watching banks matters even for non-bank investors. Another missing piece is opportunity cost. When bonds and cash offer meaningful yields, investors reassess equity risk. Banks, despite being financial institutions, are still equities. If risk-free or low-risk assets offer competitive returns, bank stocks must offer more to justify volatility. If they cannot, prices adjust. This is not bearishness. It is math. Higher discount rates lower present values. Bank stocks are especially sensitive to this effect. Markets are also responding to complexity. Financial institutions are hard to analyze. Their balance sheets are opaque compared to most businesses. When uncertainty rises, investors prefer simplicity. They rotate toward businesses with clearer cash flows and fewer moving parts. Banks suffer from that preference shift. What investors often miss is that this process is gradual and rational. It does not require panic. It does not require bad news. It requires only enough uncertainty to change behavior. This is why the selling feels quiet rather than dramatic. No single event caused it. Multiple pressures accumulated. Each one alone might have been manageable. Together, they altered perception. Perception drives valuation. That does not mean banks are uninvestable. It means they are being repriced for a different environment. Some will adapt better than others. Capital strength, management discipline, and business mix will matter more than growth stories. For investors, the lesson is not to chase falling prices blindly, nor is it to assume catastrophe. It is to understand what the market is signaling. Bank stocks are falling because investors are demanding clarity, stability, and compensation for risk. Until those return, valuations remain under pressure. Markets are not predicting collapse. They are recalibrating expectations. And that is what many investors miss.